Okay. As we move into our panel session of the conference, I just want to take a minute to talk a little bit about our panel structure. So each panel has 2 or 3 panelists. We're going to give each panelist a 10, 15-minute opening to kind of give you a little bit of an idea of how they approach the market and give you a little bit of background about themselves. And then we'll move into an educated moderator panelist Q&A discussion, kind of get a little chatter going, and then we'll move into Q&A from the audience and the attendees. So our first panel is the Institutional Money Management Panel. It's a practitioner's review of technical analysis and portfolio management. And I'd like to introduce Dan Wontrobski, Director of Technical Research at Janney Capital Markets. I'd like to make a quick note, actually. Janney Capital Markets has been a great supporter of the Boston chapter. For those of you who are members of the Boston chapter, we've held quite a few of our monthly meetings over at Janney Capital Markets in Boston. They have a great office set up and an unbelievable roof deck. I'm not sure if you've had an opportunity to get up there, but I believe it's on about the 30th floor. It's probably one of the highest outdoor spaces in Boston, and thanks to Pat Fagan. I'm not sure if he's here yet, but Pat Fagan, sales trader at Janney Montgomery, has been very supportive of our chapter, and we look forward to hopefully holding a few more events there this spring and summer. So thanks again to Janney, and I'd like to pass it over to today's moderator, Dan Wontrobski.
Thank you. Thanks very much, Bill. I'm very excited to be here, and thanks very much for that plug. That's nice. The deck is very nice, although today I don't know that we would want to venture out there just yet. We'll wait for the clouds to clear a little bit. Anyway, I'm really excited to be here because, you know, my career, when I look at this panel, I'm thinking collectively between the 3 of them, they have about 85 to 90 years of market experience. I hope I didn't insult anybody age-wise there. They all look very young and sprightly, so that's good. But I think it's amazing that we're given the opportunity to peer into the buy side and what a technical analyst does over there. I know many of us have had sell-side experience. I know there's been a huge proliferation of the hedge fund industry over the last 20 to 30 years. In fact, it's exponential. But what's most impressive to me is the usage of technical analysis during that period. Not only has technical analysis flourished, but it is increasing, you know, every year. Firms that don't employ, firms that don't staff buy-side technicians in-house, like these fine gentlemen, they're increasingly reaching out to the sell side to kind of fill the void for that resource. In my last 16 years in the business, I've met with hundreds of PMs and analysts. 80% of them were fundamental. Not too many technicians, but it shows, you know, how interested people are in this discipline. And I can tell you that across that spectrum, across all those fundamental PMs and those analysts that don't profess to use technical analysis every day, a lot of them have a keen eye for the charts. A lot of them are watching what's going on very closely. So I think it puts a tremendous amount of pressure on these guys to perform very well because they're really the leaders of the industry. So let me just really introduce them quickly. We have Dave Lundgren, who's CMT CFA, and he's with Wellington. He's a technical analyst there. We have Mark Dibble, who is the senior technical analyst with Fidelity Investments. And we have Larry Berman, who's a CFA, CMT, and CTA. He's the Chief Investment Officer of ETF Capital Management up in Canada. So without further ado, we're going to ask each one to give about an 8 to 10-minute presentation, but I've told them I'm giving them a lot of latitude because I want to hear what they have to say. Each one will go 8 to 10 minutes, starting with Dave. After that, I'll open it up to some questions. I have some questions of my own, and we'll see how the discussion gets rolling. Without further ado, let's get Dave Lundgren up here. Dave? Yes.
Good morning, everybody. I was thinking, Dan, that the reason you were going to say that we shouldn't be up on the roof of your building is because the market's plunging today, and there are no railings on the roof of the building. So as you know, today's panel topic is, for this panel anyway, is to discuss technical analysis in the institutional community. And there's, of course, that's kind of an open-ended topic, so we can talk about a lot of different things, and maybe we will in the Q&A after. But what I thought I would do to kick off the panel would be to just talk about what I think is one of the greatest challenges that we face as technicians, as we are either trying to raise money as technicians or as we're trying to sell our research into the institutional community or even the retail community. And to me, that challenge is trying to convince or demonstrate to a fundamentally minded investor what the true value of technical analysis is. Because until you can bridge that gap between how fundamental analysts and PMs or whatever your client may be, how that person thinks about the world and how a technician thinks about the world, you can't really talk about technicals because you're just going to be losing them throughout the discussion. They're going to be distracted, and you have to sort of bridge that gap before you move on to strategies and topics and things like this. So in the end, I think if you can convince or help your prospects see that technical analysis is not some voodoo science, and that it's actually very much in tune and tied to what they love and respect the most, which is these fundamental trends. If you can get them to understand that there is a very strong link, and we'll talk about that link in a moment, then you can start talking about specific technical strategies and things like that. So what I thought I would do is just give you some examples of how we try to bridge this gap with our clients and even our colleagues internally. One of the things that we do, in addition to our team managing money, we also provide a lot of research to the firm internally. And so we, other than the four of us within our group, everybody else is fundamental. So we need to have these kinds of discussions with them as well. And so what I would do is to just give you some examples of some of the methods and techniques that we use to help bridge that gap. So when I do this, I pretty much go right at the heart of it, and I confront the holy grail of fundamental analysis, which is the efficient market hypothesis. Does anybody mind if I can't step down, right, because of this? I can't. No, that's okay. I can't juggle. Okay, thank you though. So I go right after this, the efficient market hypothesis. So we know that there are three sort of sub-definitions of this hypothesis. There's the weak form, which says that prices already reflect all past publicly available information, and as you know, this is probably where technicians most get, this is the bucket that technicians get sort of poured into. Then there's a semi-strong form of the EMH, which is that prices also automatically adjust to reflect any new information, so there's no advantage you can gain there by reacting to information as it comes out. And then lastly, the strong form, which states that in addition to the weak and semi-strong parameters, prices also reflect all hidden or insider information. So this is academia's way of trying to explain why it is very difficult, if not impossible, in their view, to beat the market. Now, I think history probably proves out that it's very difficult to beat the market. There are not many PMs with a long-standing record of having been able to beat the market over a long period of time. However, although that is true, I think that this EMH does a poor job of explaining why. Now, you'll notice that in each of these definitions, I've put an asterisk after each word reflecting each of the definitions. And it's here where I think we need to insert a critical phrase that's missing from this definition. And in so doing, we can elevate the relevance of the EMH as well as shed a lot of light on the true value of technical analysis. So the phrase that I would have you insert is how strongly people feel about. Now, when you do this, let's just go right to the final definition. You have the strong form, which is prices also reflect, in addition to the weak and semi-strong parameters, prices also reflect how strongly people feel about all hidden or insider information. And when you do this, what you end up recognizing is that, in the end, the market is ruthlessly efficient at reflecting how people feel, not just the data in some laboratory setting. There's human emotions involved here. There's human interaction with the data. So it's not just the data itself. It's how strongly they feel about the data. And what we know is that this process is a positive feedback loop. So when you make an investment in the market and the stock goes up and you start to, your confidence begins to grow. You're on the right side of this. And then you do that another stock and another stock. You add to a stock that's up and it continues to go. And you do this through a full cycle, a full bull cycle, what happens to your confidence? Your confidence goes up. What happens when that happens? Well, you start to apply higher PE ratios. You start to extend your investment horizon. How far out you're willing to forecast your earnings. You start to lower your risk premium that's required on the investments you make. And that's what ends up happening in the market. And that's, in the end, you end up having these, what are termed by those that can't get their minds around it, these irrational trends. And they happen in both directions. So it's important to remember that it's not just the facts. It's how people interact with the facts. And it's the fact that human nature is involved in this decision-making process. And so, therefore, you have these trends. And what we need as portfolio managers, and I mean this for technicians as much as fundamentalists, we need a set of tools that can help guide us through these cycles of investor psyche. And so what we try to impress on our clients is the importance of technical analysis in doing that. So simply stated, technical analysis helps us consistently uncover where the best fundamental trends are in the market. It also helps us to get a very strong sense for how people feel about those fundamental trends. And then lastly, and most importantly, it gives us a heads up well in advance of substantial loss when the ultimate weighing machine, or the market itself, feels differently about the data today than it felt yesterday. So that's what we try to impress on our clients, and then we use a few examples to demonstrate how this actually takes place in real time. So this first example, of course, is a company we all know very well. It's Amazon. And just to give you some quick stats on this, in the beginning of 1998, Amazon's revenues were 148 million. The market cap was $2 billion, so it was trading at 13 times revenues. At the end of 1999, the revenues were up 1,000%. The market cap grew 1,400%, and the price-to-sales ratio was 21 times. So if you thought it was expensive at 13 times revenues, it went to 21 times. But if actually you look at, I'm talking about there, if you actually measure the price-to-sales ratio here, back when the revenues weren't as high as they were here, but the price is equal, you had a price-to-sales ratio of 174 times. So what we have here is a very good example of explosive fundamental trend, explosive technical trend driven by explosive fundamental trend. So you have strong fundamentals, and you have the ultimate weighing machine on board with that trend. Now, over here, we start to note, all the things we learn about technical analysis. We start to note a potential change in the way that the ultimate weighing machine is considering these fundamentals. We see crossing of the moving averages. We see break of trend lines. We see relative performance breaking down. We see all these things that kind of give us this heads up that the market today feels differently about the data than it did yesterday. And so when we fast forward to the earnings over here, the market cap was down 91% from peak to trough. And I think it's kind of interesting because right over here at that peak, the confidence in this trend was so exuberant that Time Magazine didn't put somebody who saved the world or cured cancer or did some humanitarian thing. They put Jeffrey Bezos on the cover, and he was Man of the Year that year. That's how confident and exuberant the trend became, and therefore you have your 174 times revenues. But now, when you fast forward to over here, you have the market cap down 91%. And can anybody take a guess at what revenues did during that period? Yes. How much? So I think it was about 18 months. No. 90%. It's still a big number, right? So the point is that if you were smart enough to have forecasted in 18 months this company is going to grow its revenues 90%, and you invested based on that methodology and on that process, you lost 91%. So that's to me is the key takeaway. It's marrying these two concepts: fundamental trends and recognizing when the market cares about it and doesn't care about it. And I think it's interesting when you fast forward to today. Revenues are up 1,000% from the bottom. Market cap is up 2,700% from the bottom, and the price-to-sales ratio is 2.2. So that's the gist of what I want to point out. So what I want to do here is just give you another example, just to demonstrate that although I was cherry-picking for that example, I cherry-picked from a very large orchid because there's a lot of these examples, and this is just another one. Over here, this is a home builder. Whoops. This here is a home builder. Lennar Holdings, market cap was $1 billion at the beginning. Revenues were $3 billion, 0.33 times earnings, times sales. When you fast forward to the peak, the market cap grew 789%, revenues 237%. And of course, right over here, you guys recall this article, the cover of this magazine? This was a picture of a guy hugging his house, right? And the caption says, "Home sweet home, why we are going gaga over real estate." So you can pretty much imagine that this concept of home building is, home ownership is fully embraced by the marketplace. But as technicians, we also know what to look for in terms of, when is the ultimate weighing machine changing how it interprets this data. And so we have this period of distribution here. We have what's clearly a head and shoulders top, breaking of a trend line. But before even all these breakdowns happen, going from here to here, the market cap went down from here to here, right, that point there, roughly 4%. Guess what revenues did in that window of time? 55%. So the fundamentals are trucking along, but the ultimate weighing machine is telling us that something is different, and it feels differently about the data that's coming out. And of course, we now know that from here to here, the stock went on to decline 85%, and revenues declined 72%. So in the case of Amazon, you had an imploding stock with explosive fundamentals. In the case of Lennar, you had imploding fundamentals in an imploding stock. So the point is, unless you're on the right side of that stock trend, regardless of what the fundamentals are, if the ultimate weighing machine doesn't care, you're not going to make money. And I think that's probably something that Ned Davis has taught us all over the years. And I can't let this one go. So, by the way, you remember this cover? So remember that back here, home sweet home, guy's hugging his house. Here it is, a very sterile environment, and the thing says, rethinking home ownership. I don't know if you can read this, but it says, why it may no longer make economic sense to own your home. That's not a commentary. I like the picture. I wanted you to see that. So this concept is just as relevant at the market level as it is at the individual stock level, and as well at bottoms as at tops. And so if you remember these covers, you may or may not, but these all appeared in succession. This is you're on your own, baby. There's nobody here going to help you. Good luck with that. There's understanding anxiety. I mean, look at this poor woman. She's probably, what you probably don't see is she's probably in her closet somewhere. She's hiding behind a blanket. She's scared to death. And here's why, of course. It's the end of the world. Will you ever retire? Well, not if you don't get out of your closet. Are you ready for war? I mean, do you see any reason to be bullish here? Right? Of course not. But we're not done. How about this poor soul? The guy's duct tape. He's wrapped in duct tape. What an unfortunate condition, right? America the anxious. The truth about SARS. Remember SARS? I mean, that was, all joking aside, that was a very scary time. And so was this. Remember the Beltway sniper? That was some scary stuff. Where's my pay raise? Of course, we're still not making any money. We're not going to retire. You remember this, the blackout, when the whole Eastern Seaboard blacked out? I was up in Canada taking my kids to the Hockey Hall of Fame. We were in a sort of the lower level floor of a large building, and the whole thing went black. And I had my 3 kids. I'm trying to scramble them together and get them up and out of the building. We get out. It was just absolute chaos. We had to siphon gas out of my friend's tank to come home. I mean, these were scary, scary times. I thought they were anyway. So once again, do you see any reason to be bullish here? And in a word, of course, yes. You knew this was coming. But this was the bottom in 0203. And what I've done is I've put a red box where each of these magazine covers appeared in sequence. And what I think is interesting is that as these, clearly what the trend was telling you was that, the ultimate weighing machine cared very much at that moment about these various covers that were being published. But what we, as technicians, we start to see the head and shoulders bottom, crossing of the averages, break of the downtrend, movement through the last swing high of the downtrend. These are all classical trend following techniques that we can use to indicate that the ultimate weighing machine cares differently about the data today than it did yesterday. And what I find particularly interesting is how 4 of these magazine covers actually appeared after the bottom was put in. And what that tells us, and this is very classic, and in fact I think it's happening today, what this tells us is that for much of the initial phase of the rally, investors are basically in denial of what the market's trying to tell them. And of course, the more things change, the more they stay the same. So this is the bottom in March of 09. And I think it was literally the day that the market bottomed, we had this cover here, holding on for dear life. So this is a concept and a process that repeats throughout time. It repeats at the individual stock level. It repeats from cycle to cycle. And I think if you think about where we are in today's environment, we can probably say that investors are now just starting to embrace what the market's been trying to tell them for 2 years. We're starting to see positive money flows into the stock market, and people, of course, the American Association of Individual Investors, their survey is now highest it's been in years, but I point out that it was actually higher in the 03 to 07 cycle, and so I think these are signs that the market is actually starting to sort of transition from denial to acceptance, and that we're only just starting to get in, so there's nothing to really be exuberant about. So if this holds true, then we probably have a bit more to go here with the market. So just in summary, once again, what we try to impress on our clients is how technical analysis consistently leads us to the best fundamental trends in the market. Not only that, but it also gives us a very strong sense for how strongly the ultimate weighing machine feels about those trends, and then most importantly, it gives us a very clear heads up of when the ultimate weighing machine has changed its mind and no longer feels as strongly about the data. And this all plays out in the interaction between fundamentals and technicals. And again, we just try to impress that this is why technicals are so important.
All right, thanks very much, Dave. Next, we're going to have Mark Dibble from Fidelity. Come on up, Mike.
Thank you. Thanks for being here. It's an honor to address this group. I've actually been a member for 22 years, and first time I've actually spoken at the MTA. So a lot of you I've known for more than 10 years, so I really feel at home here. So just as a brief introduction to how I got here, I started out as a summer intern at Cowan & Company in New York when I was in college, and then hooked up a job with a guy named Rick Akel there when I graduated. He was an old point-and-figure technician. I think some of you know him. He's retired now. And then we went over to Morgan Stanley shortly after I got to Cowan & Company, and I was there about 10 years, 7 years in research, and then the last 3 on the trading floor working with a proprietary group as well as speaking to clients, something that probably wouldn't be allowed right now. And then I've been at Fidelity for, I guess, about 17 years, which is, I jokingly say it's 34 in human years. I have a whole list of reasons why to use charts, and I'm speaking to the converted, so I'm not going to drag you through that. But one of them, which I think is just so patently obvious, is that when you look at the grand sweep of history, and it's 200 years of the Dow, if you've been doing this a long time, like I think Roy Neuberger on this chart has got the longest run. He just passed away last December after 70 or so years in the business. You only get to see a few different cycles. So if you can use charts and learn about the market, you can actually expand your tenure beyond younger analysts. Face it, most of the analysts, fundamental analysts, are 5 or 10 years of experience. When they talk about the long term, they're talking about 10 or 20 years. But we all know that the long term goes much beyond that. So the way I would do that is to learn about past cycles by reading about important investors and going through the charts as you do that. It's never quite like living through the period at the time. I know a few people in the room were around for the 74 low. I don't know if that was any scarier than the 09 low, but some stories are that it was. So, 3 books that jump out to me that I would read and also look at the charts at the same time are Reminiscences of the Stock Operator, which is a fictional account about Jesse Livermore, the Market Wizards book, and I think there are a couple of those on that. And then finally, but not finally, there are hundreds of great books, but finally for me, Adam Smith's The Money Game, which really gets the juices flowing. So expand your tenure by looking at charts. I like to refer to a chart pattern and use it at Fidelity as the Fidelity fat pitch chart. The dirty secret is a lot of the portfolio managers at Fidelity don't like buying the new highs lists. I certainly do, and I know a lot of you do. But they don't want to buy the new high, and they often get teased if they buy the new high, and there's a way to go in and see what everyone's cost basis is in every stock. It's on everyone's desktop. So the Fidelity fat pitch chart for me is a stock that's in an uptrend, a long-term uptrend, that has a setback, and that setback can either be time or price. And that setback creates pessimism in the market. And pessimism here is that final clip. The line is purple. It's a little hard on the eyes, I realize. And that measures optimism and pessimism in the stock, in the options market. So when that series is low, and I've highlighted it in green on these three charts, that means there's pessimism in the options market. So that's kind of one of the setups that I use to pitch stocks to portfolio managers at Fidelity. I think I skipped one there. This one's more on processes as well. The dirty secret is that most funds at Fidelity don't do market timing. We have to be pretty much fully invested most of the time around a given mandate, be it growth or value, capital appreciation, a foreign mandate. So when managers get offensive or defensive, they tend to reflect those bets in stock selection. So this is a screen that I run with some of the managers at Fidelity, and these names and the weights and all the information is not real. I don't want to get myself into trouble. So this is a screen I would run on a contra fund. It's our biggest fund. So the first few names are tech stocks that theoretically the manager owns in that fund, and the next three names are stocks that he could own. And the process is very much of a push-pull model. We're trying to get the manager to sell things that are bad and push them toward things that are good. And at the end of the day, it's a chart review exercise. I'll go through, say for example, Contra owns 200 names, and then there are 100 or so others that I want to push them toward. I'll go through those 300 names and then pitch them on the high conviction names. Some of the things I look at, in addition to the charts, are whether our fundamental analyst likes the name or doesn't like the name. So let's see if I can use this laser pointer. So in that first grouping, the Acme Interactive is one that, for argument's sake, is not liked by the fundamental analyst. It also gets red marks across the board on some quant models that we've found to add value. I'm not a big believer in quant models. I find it an effective way to communicate with portfolio managers or to describe the investment landscape in terms of what's good and what's bad. And we've also got internal quant models, as pretty much everyone does these days. And so another type of bet we would make is look at Microsoft, which is obviously a large capitalization stock, big in the benchmark. If something like that were not attractive, we would recommend underweighting something like that. So that's all the bad stuff. And the good stuff is we like it on the charts, or it's got support from quantitative models, or it's making new highs or relative highs versus the benchmark. I like to refer to that as the truth wall, whether a stock's making new highs or relative highs. And the relative high thing is a nuance, and I'll have more on that in a future slide looking at relative strength. But we screen on stocks making new relative highs. It's obviously the stocks that are leading the market currently. It's debatable whether they will continue to lead. You heard Jeff DeGraff gave a pretty convincing case for sticking with trends and not fighting them. And then the final comment on this slide is the area that's yellow on the screen. You'll notice that there's no fundamental rating and no fundamental analyst. And either that or there's this guy named Na. Na covers a lot of stocks at Fidelity. And he covers a lot of stocks that have got really good-looking charts. So I jokingly refer to this as the Fidelity neglect screen, stocks that look really good with no fundamental coverage. And those typically are often of interest to portfolio managers as a way to differentiate themselves from the benchmark and the rest of the process. I went to ISI's macro conference about 3 weeks ago and had the pleasure of sitting in front of Paul Tudor Jones interviewing Stevie Cohen of SAC. And he said something that really jumped. There was a lot of talk about using technical analysis. Paul Duder-Jones is a big advocate of using charts, and you can go into the Market Wizards book and unearth that. So Stevie Cohen said the slow grind up with stocks, he was talking about the last 6 months, with stocks exploding higher is very bullish. And I see that as very, very telling. And I spend a lot of time going through hundreds and hundreds of charts a day. And I get much more of a view of the market by a bottom-up approach of looking at hundreds of charts, much less so of looking at the S&P 500 or broad market averages. So we've got the S&P 500, that's the top chart, which you've seen already a few times today. And the next 10 charts, I just picked out a good-looking chart in each of the 10 sectors. So in some cases, it's large-cap stocks like Disney or Chevron, Texaco. In other cases, it's kind of small stocks that are kind of off the radar screen, Calpine, this Mastech, that's the MTZ, the industrial stock. So I'd like to think before this move is over, we'll find fewer bad-looking charts when we go through the market and more, fewer bad-looking charts and more ugly-looking charts. And sometimes the tops play out that way. You get the classic 19th century distribution, and other times not. You can do contrary opinion at Fidelity often without leaving the building or with some of our customers' assets. So Fidelity was pretty early on in using sector or group funds that specialize in a given sector, be it rather narrow like biotech or rather broad like an entire sector. So this is a long-term track record of all the sector funds, the select funds that roll up into the technology group. It's about 6 funds right now. It's about $6 billion. Now, clearly, we've lost a lot of market share to ETFs. The Qs are essentially a tech fund. But it's still an interesting laboratory for measuring how concentrated the public is in any given sector. And the dirty secret is you tend to get herding mentality at extremes. So if you look at the technology group, you obviously had a lot of buying toward the end when Jeff Bezos was Time Person of the Year. So we started this business in 1980. You can see a few oscillations here where the public gave us roughly 3/4 of their money in this select group. That was pretty close to an important secular top in tech in the early 80s, and then it dwindled down to 7%, kind of flatlined there for a long time. Obviously came back with the dot-com boom, and then has now been flatlining around that 10%. I'm hoping that's a bullish tell for tech. It's not, it's kind of like a special team in football. You're not going to win the game on this one chart, but tech is clearly out of favor in terms of the asset base. I mentioned relative strength a few slides ago. When I go through these hundreds of charts, one thing that really jumps out to me is that stocks that were defensive in relative strength, that is outperforming in the downturn, have lacked offense in the last 2 years. So most Fidelity portfolio managers are trying to beat benchmarks. So if you essentially own stocks that are going up in absolute price but are lagging the benchmark, you're not adding value. Correlation got so high and has been quite high for the last 2 years. I often bucket stocks just binarily if they're offense or defense, and very few stocks that have been both defensive in the downturn and also offensive off the low. So that would be the exception. That would be like Apple, for example, which has been kind of the stock for all seasons. So Procter was a really ugly absolute chart on the way down, but a great relative chart if you're trying to beat the benchmark. And the opposite's been true over the last 2 years. I think this is something that the buy side probably focuses on a little more than the sell side. This is my final slide. I think most people assume that we're in a secular bear market. The stock market's starting to come up to where it found resistance in 2007-8. If I had to offer one chart that maybe that's not the case, that would be the Value Line Composite, which is a very broad average of kind of what the average stock in the U.S. is doing. I think it's about 1,700 stocks, and it's equal weighted. And that is pretty convincingly taken out the 07 high. The mid-cap index is marginally taken out that high. The small and the rut are pretty close. And if you look at the relative strength, it's been pretty persistently strong since the March 09 low. Of course, it's been persistently strong for much of the last 11 years as well. But I think that's hopefully a bullish tell for a continued strength in the market. And I'll stop there and pass the baton. Thank you.
right. And finally, Larry Berman. Larry?
Thanks. So we're still 10 minutes or so? Because usually when I speak, I go over, so I ask for a 10-minute warning.
We have a hook.
I'll probably go over. It's going to take me a while to tell you about the U.S. economy. So I'm Canadian. I worked in Boston for a couple of years, so I was very thrilled to be invited to come back. You know, as an unbiased investor, I try to be unbiased. I'm a global macro guy. Client gives me $1 to invest, I put it into 20 nickels and I spread it around. And I use ETFs, and ETFs are quite elegant for global macro strategy. I think it's a house of cards. China, the U.S., you guys are fucking broke. Can I say that? You know, maybe we can take that off on the tape. Okay, so Congressional Budget Office, I do some fundamental work too. We'll get into some charts. Congressional Budget Office says it's going to get worse until the cows come home, and Congress isn't doing anything about it. They're going to have this little vote next week, I think it is, and maybe raise the debt ceiling, and I don't know. But what's interesting is they changed the way they do this, and they actually put a new line excluding interest. I thought, well, we just won't count the interest we owe. Anyways, the physical problems of governments in the world is not getting any better anytime soon, and it's not going away. And governments aren't making the decisions they need to make. In some places they're being forced to, but it's really only because they're being forced to. The Dallas Federal Reserve, and I don't know how, nobody talked about this, but about 8 months ago, Dallas Federal Reserve did this paper. And basically, according to their calculations, the unfunded debt, Social Security, Medicare, Medicaid combined is $104 trillion. Now, that's looking out 30 or 40 years and doing a present value discount, I suppose. But where's that going to come from? In Canada, they scrape money off our paychecks, and they actually put it aside. Here, it's general revenue. I mean, wow. Yeah, it's the way it is. So where's that money going to come from? Well, taxes have to go up, and there's all kinds of problems to come. Forget the stocks, forget the charts. I mean, the world's got problems, and it's all over the world. So who's been down the road before? You look at Japan. Japan's got a debt to GDP that's far worse than the U.S., although if you do the real accounting and what they really owe, the U.S. is bankrupt. 1993, Canada's fiscal situation was awful. Moody's downgraded Canada. Standard & Poor's downgraded Canada. That would have been 3 years ago. Okay, you guys should have been downgraded. Absolutely. Why? Well, Standard & Poor's and Moody's don't have any balls, or there's political pressure or something. But again, the world's in bad shape. So then Bernanke and company comes along. So POMO is a permanent open market operation. So normally the Fed controls the money supply by doing repos and reverse repos. And every time they get in and print money, they create liquidity. And it doesn't seem to be getting lent out by the banks in any significant way because corporate America doesn't need the money, and they got pristine balance sheets for the most part. So every time they do this, called quantitative easing, it juices the markets. Japan's on QE 15, I think. I think the U.S. economy is heading towards Japan-style inflation. I'll get to the charts in a minute. But I look at things being a CFA fundamentally, and I look at technicals, and the technicals help me with the when decision. But you've got to have some sense of what's going on. I mean, you could put on the blinders and just look at charts and do things that way, and that works for some people, but sort of not the way I do things. I was on the sell side for the vast majority of my career, and last 4 or 5 years went out on my own, hung a shingle up, started managing some money. And it's vastly different managing money than telling people what to do with the buy and sell recommendations. It's vastly different, especially when you have close client contact like I do. I do a TV show in Canada. It's on the network. It's called BNN. It's the equivalent of what CNBC is down here. It's our business news network. It's the only half-hour show that I know of in the world dedicated to technical analysis. People stop me on the street and ask me about stocks, and it's just insane. I have a lot of contact with the end investor. It's the client. The end investor is that individual. The whole system is set up to steal from the individual. I'm going on and on. Pardon me. I worked for a bank for a long time. Earnings are great, but it's because they steal from individuals. Okay. But earnings. So let's go to earnings. So I remember in 2008, Abby Joseph Cohen gets on CNBC, and just after they came out with the Barron's Roundtable, and she says, "We're looking at forward earnings here, and S&P should do $100 the end of 2008. So fair value for us is $1,600, $1,650." And I said, "She's a pretty smart lady. She's worth an awful lot more than me as a partner at Goldman Sachs. Maybe she's right." Well, she was wrong by 50%, right? Earnings don't adjust until after the fact. So the fact that forward earnings 2 years from now is $120 for the S&P should be meaningless to us when we're trying to evaluate the outcome, but it isn't. That's what drives the world, right? It's earnings. So you look at things, and I say on my show every week, I do a little bit of recap, chit-chat on what's going on in the world. I said, listen, analysts are still goosing up earnings. It's okay. Because the vast majority of the world, values markets based on earnings. They don't care about that the U.S. government's bankrupt. They just care about earnings. What did we do this quarter? What's coming next quarter? That's all that really matters. Working on the sell side as a technical analyst for many years in a research department, you see the fundamental guys pound the table at my stock, and I'm bullish, I'm excited, and they look at the company like this. They don't look at what's going on here, but management tells them they've got oil in the ground and they've got this and that. They get excited about the story, and they have very little concept of the world. So when we look at earnings, it's interesting. It's one part of the pie, and it's a very supportive part of markets at times. But you can see here that forward earnings forecast didn't start to drop significantly until September and October of 2008. And by that time, of course, it was vastly too late. But right now, everything looks terrific. So, when I'm running global macro money with ETFs, what we do to people, we say, listen, I can manage the money. We use relative strength models. I'm going to talk a little bit about that. But we say, well, what's your risk, Mr. Investor? Well, emerging markets over the last 20 years did 32% a year. I want that return. Okay, can you handle 52% volatility? Well, what does that mean? Well, it means 2 years ago you made 130%, but last year you lost 70. So net, you're down. Oh, that's no good. Yeah, but the industry sells the guys who advertise on my show are mutual fund companies. The industry sells returns, right? The financial planning community, one of the ironies of the financial planning community, they go out and say, 8% a year, this much in tax, and you should have this much in 30 years. Ibbotson did a study. I should have put the chart in here. Ibbotson did a study, and they said you get that average return, okay, if you have a 42-year horizon. 42 years you need to get that 8%. Otherwise, you're lucky because of the volatility associated with markets. It's pure luck. So if you were the poor schmo who retired in 2000, the vast majority of your money is in the U.S. market, you're not really happy here because you've got $1 million. You take 50,000 out a year, and then we had this big drawdown, and we had another big drawdown, and that 50,000 instead of 5% of your portfolio is now 10 or 12 or 13. You're never going to get even. You're never going to get back the whole. Okay, so the whole as we age as a population, demographic problems we have in the world, that's a big thing. It's buy and hold can't work for retirees. They don't have the horizon, okay, to get that average return that we're promising them as an industry. Anyway, so I set up this business with ETFs to try to address that problem, and I think they're great tools. Okay, I'm going to tell you a little bit about how we do, and we've heard twice, the markets are hard to forecast. We don't get it right all the time. This chart from Bloomberg is the JP Morgan Global Treasury Benchmark in the world. Okay, that's the red line. And the green line is the Morgan Stanley World Index Total Return. That's the world of stocks and the world of bonds. You look at the relationship. 2007 came along, looking at the relationship of the relative strength line on the white line there. We put a linear regression on it. Look at that trend, stocks underperforming bonds the last number of years. It's now coming back to the top. But in 2007, stocks were expensive relative to bonds. So you rebalance your portfolio a little bit. I mean, and you do it statistically, right? You can use Bollinger Bands, anything you like. One gets expensive to the other, you rotate, you sell out. So that's what we do. We're always looking at relative models. You got $1 to invest, split it up into whatever you need to split it up into, and you put a nickel in each place that you think makes sense. And when something gets expensive relative to something else, you take it off the table. So interesting observation here. The global stocks, global bonds, priced, for me, is priced in Canadian dollars. The chart isn't that much different. But, we're starting to get to an interesting point now. So what does it mean? It means different things for different people. Doing a TV show where people call in and say, should I buy this stock? Like, when I tell Americans what I do, I said, I'm like, Kramer on Mad Money. I'm the Canadian guy, except I'm civilized. You don't know, right? What's your time frame? Do you own it? These double bull and double bear ETFs that they have, and the triple ones, these are toxic. Okay, they rebalance every day. You hold for more than a couple weeks, and the NAV erodes, and they're toxic. They're cancer. This woman calls the show about a year ago. HNU is the natural gas double bull. Okay, my friend's been telling me natural gas is cheap. It's $4. They don't understand futures contracts. They don't understand the role, but they've got this product out there that's killing people. So the woman, 60 years old, had $800,000. I told her to call me in my office after. 800,000. She had put 400,000 of the 800 in, kept averaging down because natural gas was going to go up. Listen, it's $3, $4. It's got to go up. Man. Anyways, sidebar. Sorry. Okay, so we're looking at placing the money, whether it's commodities. I mean, everything has different risks. So we have our buckets. We tell the client, listen, here's your exposure. This is what it's done in the last 20 years. This is what it's done in the last 10. We manage relative strength. We're going to rotate sectors. We're probably going to do a little bit better than buy and hold. Maybe beat by 200 beeps in a year in a strategy. So that's pretty rock star territory if you can beat the index on a consistent basis. I'm not saying we're doing that, but I'm saying that, that's pretty good. So generally we guide people along that way. And so how much commodity you want? How much can you live with? Okay, here's your mix. Well, if you held this over the last 10 years, this is what your return would have been. Okay? You add our style to it. Now, the key thing, of course, is the asset mix between stocks and bonds. Okay? So there's the rule of thumb in the industry that, okay, you're 70, you should have 70% fixed income. Who wants 70% fixed income with interest rates where they are today? That's insane, right? I mean, maybe that's why stocks are rallying now, but that's another argument. So again, looking at things in a relative. So DJP is an ETF that is a UBS, Dow Jones commodity basket, but it's all futures contracts. So you hold for long periods of time. You have some NAV erosion there. But, the snapshot here, again, commodities get a little expensive. We sell some out, come to the bottom of the line. Listen, they're outperforming stocks over the last year. So you want to have a little bit more in your portfolio, and you just kind of move around. And it's no different than just, basket of stocks. I've come to MTA conferences for, better part of 20 years now, and everyone just talks about single stocks. So a little bit different here in terms of baskets, and ETFs are just great for that. And, okay, so emerging markets, relatively cheap now compared to ACWI, which is the, Morgan Stanley All Country World Index. China just had a trade and just announced a trade deficit last night. Obviously part of today's concerns, but emerging markets are a little bit cheap now relative to the world. So makes sense to make a little allocation here. And, I've set up my time frame that I look out 1, 2, 3, 4 months kind of thing. I have some confidence regarding what next quarter's earnings might be. I have some confidence in the charts when I look out. I have no idea what's going to happen a year or two from now. No one does, right? I mean, government changes policy here or there. Maybe they get their act together, balanced budget amendment to the Constitution. They're talking about that now. I mean, would that be radically bullish for stocks? I would think so. But anyways, you never know. So you do things based on probabilities, right? What are the odds right? So I always like to play this game, and I'll leave you with this. So it costs $10 to get in, and the odds are 6-1. So it's like rolling a dice. Pick a number. If your number comes up, I'm going to pay you 10-1. So who wants to play that game? The odds, right. I mean, it makes sense, right? Am I wrong? 6-1, it's $10. I'm going to pay you 10-1. Odds are in your favor. It's better than the casino, right? So fine. Okay, so think about risk. Same game, exact same odds, except it's not a dice, it's a revolver with a 6-chamber and 1 bullet. You still want to play, right? So risk is understanding risk is pretty important. So, I mean, that's what we do as technicians, right? We try to manage risk for people, and that's one of the new taglines that the MTA adopted a couple of years ago. And I will leave you with that. Thank you.
All right, and thanks again to Dave, Mark, and Larry. Appreciate your comments. I was going to just start off with a few questions of my own, and then obviously we want to open it up to the audience. There's really two ways we can go with this. We can talk about, what it's like to be a buy-side technician, or we can get, into the meat of things and get, these guys feel for what they think about the markets right now. I know at our last break, everybody was checking their BlackBerries, making phone calls. A lot of us were probably calling back into the office to learn that, the S&P is down, hit the 50-day moving average. I think hit around 1295 before it rebounded back up to 1300. So market's taking a little bit of a hit here. As Larry mentioned, off of China news, probably some overseas geopolitical things there. So with that being said, we'll get a little bit more granular as to what you guys think and what your firms are saying and perhaps how you're positioning yourselves. Again, we're not asking you to give away your secret sauce or anything, but certainly some insights as to our market environment would be very helpful. The first question I had was for Mark and Dave. Judging from your presentations, you're more stock, you're equity focused, stock driven. And there's an axiom out there that says, like 80% of a stock's move is probably driven by market and sector. Maybe 20% is driven by, sector and fundamentals. And I know those numbers change. It's been around for a while. I just wanted to get your thoughts on that in terms of, does a market call factor into your stock selection? So, Mark, would you want to go first?
Yeah, thank you. One thing I didn't mention when I was at the podium is that our process is long, short, sector neutral. So when we do stock selection, we're looking at each of the 10 GIC sectors, and 3 of us do this, and we've got someone dedicated on the international side doing the same thing. So we're trying to find essentially the best quintile and worst quintile in each of the 10 GIC sectors on a universe that looks like the Russell 1000. So I always have to have a tier of stocks I'm long and short in each of the 4 sectors I do, which are industrials, tech, utilities, and telecom. Now, in many cases, there's a market view baked into that because there are kind of naturally offensive and defensive ideas in each of those sectors. Sometimes it's harder to bake in a market call in utilities because a lot of them trade the same. So, I think I had the Calpine chart on the in my deck, and so that would be kind of the re-risking offensive name that has a 0 dividend yield, and whereas obviously a lot of other utilities do have dividend yields. So there's that baked in. We all have market opinions, no matter what the scheme is for either buying stocks or rating stocks, and talk about them. It's kind of like talking about sports. It's almost inevitable, especially if you're in this business. So the short answer is we don't have a market view that formally affects our timing or our stock selection, but it ultimately does get baked into the equation.
Dave, do you want to?
I would just say, Frank Texera, who's I think he's in the audience here, and he's going to be presenting later today, I think at 4.
Yep.
So one of the things that he likes to say to our clients is that we identify trend change, we don't forecast it. So we spend all of our time trying to identify the trend of the market from the bottom up, and so we spend a lot of time going through our investable universe because we're a global go anywhere fund. We can invest in roughly say 6,000 stocks, and so we make it a practice to review as many charts as we can over time. And if you can imagine the process where we have a stack of charts like this, that's our investable universe, and we take a look at the first one and we assess whether it's positive trend structure, negative, or kind of neutral, and we put it in its appropriate pile. And then we do this on a monthly basis. And if you can imagine how that process would unfold, you'd end up with 3 piles. And this pile over here would be the pile that has the charts with negative trend structure. And if it's a low pile, you can imagine that our cash balance is low. And that as charts ebb and flow in and out of this pile, so too should our cash balance ebb and flow as well. So we don't make any effort to try to forecast the trend. We just respect it, and we try to make changes at the portfolio level, one stock at a time. And we just, we had no idea what was coming in 2008, but we did know from the technical structure and from this process and how big this pile got over here that we should have an awful lot of cash. So fortunately, in our portfolio, we're able to go to 100% cash. And so by the time things got heated up, we were a substantial cash position. But it wasn't because we knew what was coming. We didn't write reports beforehand saying that it's Armageddon, you need to raise cash. We just let the process dictate the holdings in the portfolio. We just do that because we think that we just don't know.
Thanks. Larry, Ned Davis this morning kind of opened up the door to using technicals, across economic indicators. And I know, you're very globally focused, macro focused. And this is kind of a U.S.-centric question, but, if you were to take a chart of like the CCI, the Continuous Commodity Index, long-term, and plot it against, U.S., the unemployment rate, long-term, say going back to the 80s or 1970s. Look at it versus today versus back then. Two things that might stand out are commodities are ridiculously high. In fact, some of the charts are going parabolic. And we know that unemployment is still kind of, although it went below 9% last week, still hovering around 9%. These are levels that are either as high or higher than they were in the 1970s. Do you think there's the threat of stagflation potentially in the U.S. going forward?
Yeah, it's another one of those things that I didn't get into, but in the category of you guys are screwed category. One of the demographics is a big thing. So we're all aging, right? So there's 5 workers for every 1 retiree. 10 years, it's going to be 4 to 1. 20 years, it's going to be 3 to 1. We're running out of stuff. We change our spending habits, eating habits as we age. There's really, more of a push for proteins in the world. These things drive what we do as humans, right? So I think there's very real commodity inflation out there. It's a big problem. But in terms of taking technical or economic indicators and doing technical work on them, I've tried to do that. It's a useless exercise for me. It has been. It doesn't mean it can't be done, but
okay, fair enough. Thank you. Dave, this question was for you. I enjoyed your slides with the magazine covers. I think everybody else did. And we saw the different shift, right? And obviously kind of the negative correlation out there. So my quick question to you is, where are we now with those pictures of Time magazine, do you think? Are we at any inflection point? Do you look at sentiment? Do you think the markets are potentially frothy here, or maybe not there yet?
We actually get that question a lot. And in fact, I think probably because I chose to ignore it, I can't remember exactly when it was, but it was Bernanke was he named Man of the Year? Was he named
Man of the Year? Yeah.
Man of the Year. And so as soon as I had done this presentation, I had gotten an email saying, does this mean it's over? And my response was, it's all a mosaic. And so this is one, I would say very important part of the mosaic, but you have to view all of these data points in light of what the market's telling you. And if you have a market structure with a good structure, chart pack is like this, and the OK is like this, and the bad charts are like that, then if that magazine cover is the death knell and it is the beginning of the end, it's going to take a lot of time to get all these charts into this pile and then into that pile. So my response at the time was it could be, but if I'm going to follow our process like we should, then it won't be reflected in the portfolio because it's what I feel. It's going to be reflected in the portfolio because it's what the market's telling us. And so that was a while ago. I don't remember when it was, but it was.
Yeah, it was. I mean, several months ago at least.
Yeah, it might have been. Yeah, it was. So we of course didn't respond to that because the underlying tone of the market and the health of the market was just too strong. When you have at the peak in 2007, 2007, which by some measures you can actually began in 2005 and then accelerated in 2007. Then you start to see these magazine covers where, on the surface things look great, but beneath the surface, this pile is huge. And then you get those magazine covers. That's just, again, it's part of the mosaic. It's just one more nail in the coffin. But right now, if we get things like right now, the Association of Individual Investors is as high as it's been since, I think it was 2007. But what they don't tell you is that prior to 2007 and off the 03, 04 bottom, it was actually higher than it is today. So we had 3 or 4 years of gains after that extreme in sentiment. So it'll be important when sentiment gets extreme in the beneath the surface. This pile's huge, but right now it's not.
Right, and it's not necessarily the end when sentiment is extreme, right? As you were saying, you could go.
Yeah, I would make the case that the first sentiment extreme off of a major bottom is actually bullish because it represents this idea that investors are going from denial to acceptance. And if they're only just beginning to accept what's going on, then that's actually bullish. It's not going to be until you get another sentiment extreme in the Association of Individual Investors sentiment, you get a magazine cover like that, and this pile over here is huge, then you have a problem.
All right, thanks. And then one final question, and then I guess we can open it up to questions. And this was just for Mark. Like in the trading vernacular, it always goes around that there's the pain trade out there. And I think, right now, at least, talking to the traders that I speak to in our little circle, the pain trade, appears to be higher. People are looking for weakness to kind of jump into the market, to position build. And I guess until today, the market really hasn't been giving them that much opportunity. Do you think there's a pain trade still on right now? And like, what areas do you think that resides in?
I think it's a healthy question to always ask what the pain trade is, because it's something that you often see. Maybe not tomorrow, but what's the term? Change favors the prepared mind. So trying to find out what the pain trade is. George Noble said about 6 months ago that the pain trade is the sidelines, which I thought was kind of interesting, because you normally think of it as a directional thing. I think the sentiment got to a generationally bearish level in March 09. I think Ned Davis said that. I still think the pain trade's higher. I think the wall of worry resets so fast because the memory of 08, 09 was just so toxic for everyone that you see it after 2 or 3 days of down 1 or 2% in a day. The instinct to hit the panic button, I find it, I do it myself, is so strong that's actually a bullish legacy of the 08, 09 sell-off, is that the wall of worry resets fast. So I still think the pain trade's higher in the U.S. stock market.
Thank you. Well, thanks, guys. With that, we can open it up to questions from the audience. I think, Bill, you're going to walk around again with the microphone, so we can go. Were there any questions for either Dave, Mark, or Larry?
A general question on, we're being introduced into a lot of different charts and indicators and all today, and all which seems to make sense, but it results in a very, very broad range of indicators that we can look at. How large would you say the core of your indicators are that you use in making your decisions? I mean, everything seems to make sense today, and we'll leave here today with a very broad spectrum of charts that we can look at. Not stock charts, but indicators, oscillators, all those kind of things. How big is the core of, if this makes sense, how big is the core of what you use to really focus on making decisions?
Can I take that one to start? I found over the years, again, going to conferences, listening to other people speak, that everybody's toolbox is going to be slightly different, and that's what's going to work for the style of manager, trader, whatever it is for you. But you don't want to have 3 momentum oscillators giving you signals, because they're all telling you the same thing. You want to have something to analyze trend, something to analyze momentum, something to analyze the extremeness of the trend, mean deviation, Bollinger Band, something like that. Something to analyze sentiment, breadth of the market, depending on what you do. If you're an FX guy, really you only have Elliott wave. But so it depends on your set of tools and what you're doing, and it's all going to be slightly different. But you want to categorize them into different relationships, different areas, so you don't get the same message. You don't want to look at RSI, stochastics, and MACD on one chart. They're all telling you the same thing. So it's too much emphasis on one style. And so style diversification in terms of analysis, I've always found beneficial.
Thank you. Question back here.
Yeah, this is mostly for Dave, but perhaps the other two could chime in on it as well. You were talking about sentiment, especially from looking at magazine covers. Are you doing any work on measuring sentiment through social media, like looking at Twitter feeds? Because I know there's been some talk about that. Bloomberg's trying to come out with a service that does that. Have you looked at that at all, or do you think that makes any sense to contribute to your process?
I'm aware that the trend is in place and that's a hot topic. We aren't doing any work on it. So unfortunately, my answer is going to be short, no. But I think, there's any way that you can measure sentiment at the public sort of popular level is going to be beneficial. I think there might be some potential drawbacks to doing it through Twitter because it may not be as pure of a read and it may be too specific. The magazine cover concept is that it's if it's so good that if the concept is so well accepted that by the time Time Magazine makes him the man of the year, you know that it's pretty close to over. I'm not sure that you'd get that level of purity from a Twitter feed, but I think there's probably something there, yeah.
If I could chime in on that briefly. Dave used to work at Fidelity, and we've got the markets and the media wall at Fidelity. We've had a deep dive on this, and the dirty secret is the magazines are kind of going the way of the dinosaur, so which I'm sure is what you prompted your question. So the answer is yes, we're actually looking at that. We've got a business associate who's in the room here, who's tasked with that very thing, looking at social media and kind of the next generation of markets in the media. I think one thing that we need to acknowledge is that it's not just magazine covers. It's kind of social phenomena. So it's books, like the popularity of books or the popularity of movies. So it's not just media. It's kind of like what everyone's focusing on. So there are lots of different ways of measuring it. And the good news is a lot of this stuff is free on the internet. I think Google's got an engine that actually can do headline counts for free. You can chart headline counts, so you can do it yourself for free.
I got to chime in on this.
Yeah, please.
Yeah, I think it's going to be a colossal failure. Like using Twitter or something like that for sentiment. First of all, sentiment's fickle. I mean, we look at a chart and it looks bullish today, and 3 days from now it looks bearish because it broke a line. So we change our opinion. And then the stacks, right? The stacks change. So sentiment can shift dramatically. And usually when things look their best is the time you want to be negative. We know that, right? But I don't – taking that and actually turning it into something that you can trade – I think is very different, because who's going to argue with me that sentiment in November 2008 wasn't extremely horrible? Come on, someone argue with me, right? It's a hard fight to pick. Did we see another low coming, a lower low coming? It started to stabilize, it looked good, and then it started to roll over again. So what degree of sentiment, how long you're going to hold the positions, where do you stop out? I mean, all those things are factors in translating sentiment into actually making money. So I've never been able to do it.
It's a good point that you bring up in terms of, the rapid advance of technology now. So not just within social media, but within Wall Street. Now the proliferation of these quant funds, with them gaining more share of the trading volume out there. Is that a trend that you see increasing as technology advances? And do you think it could potentially make the markets more efficient, or is it the recipe for another black swan? And anyone can take that.
Next question.
No, I try not to think too much about questions that I don't find myself trying to address when I'm managing the portfolio.
That's okay. We just want your opinion, just to see how you see things evolving. Because we're all in the business.
I think that one of the most significant reasons for why correlations went as high as they did is because of the quant funds and because of all the ETFs. And it's no longer when you buy a stock, you impact that one stock. When you buy an ETF, you pretty much affect every stock in there. And so it's largely what's driven correlations to the point where they are. And I'm sure quant funds have had a measure of impact on that as well. But beyond that, I don't have any particular.
Yeah, I mean, computers are not going away, right? We know some of the causes of the flash crash, and it's just programs, right? And it's faster and faster, and correlations are going to keep going up.
We have more questions from the audience.
Dave, earlier you spoke about selling your research, and I was just wondering what techniques you find being effective for an audience less receptive than this one when you're dealing with fundamental people, and then also for everyone, do you use stops?
Was that to me?
Well, the first part about you were talking about selling your research and what techniques you find effective in dealing with fundamental analysts when you're speaking about technical.
I think the way Mark addressed it was actually the perfect way to talk to a fundamental analyst, and it's the way that I actually get the most mileage from conversations I have with fundamental analysts. Is you take their portfolio and you go through it and just isolate those stocks that are sort of in this pile, and they're happy with that, and they don't really want to look at that pile. And then these are the ones that just don't speak to me technically. And then it's this pile that's often a pretty big pile. That's the one that draws their attention. It forces the conversations that need to happen. And so it's often not the case that they end up selling a position entirely that's over here, but the concept that you want to try to convey to them is that if over here you have a stock that's in your portfolio and it's a small position, you should make it bigger. If you have a stock that's in here that's a big position, you should make it smaller. If you have a stock position over here that's a big position or small or anything, you should sell it. And so generally speaking, that's what they want to do. They want to focus on this pile, and then any cash that they raise as a result of that conversation, you give them ideas as to where to put it, preferably in this pile over here. So it's very much a very specific topic driven conversation, and it's very impactful. That's the way I found it. I think that's what Mark was trying to say as well. And then do we use stops? We do, but it's traditional Dow theory type, higher high, higher low, trying to look for the support level that matters, and you're trying to gauge the support level based on volatility around that low to try to gauge its importance. So you're not stopping off on every single low, but we absolutely use stops, because if we didn't, one of the concepts that helped us in 2008 was that as we began to get stopped out of positions using the process that you're asking about, the key to us was that as we then turned around to take that capital and redeploy it into the market, and this pile just kept getting smaller and smaller and smaller, we had no place to put the money, and we wouldn't have gotten there if we didn't respect the market with stops.
Bill, I think there were some questions over there. Sure.
I got a question for Larry. If you start with a premise that the U.S. government is screwed and we're screwed, which I think has merit, and take us through the causes and effects that eventually lead to your opinion on where the Canadian dollar will be.
Okay. I say we're screwed. It's the system that's screwed. I think the average wealth in this room is probably going to do better than most, but where the Canadian dollar is going to go. The manufacturing part of Ontario has been decimated from the car industry downturn. So the currency north of parity with the U.S., there's no real fundamental value. Okay, fundamental value as in I'm an exporter, I'm going to sell more product as it goes higher. No, because things are going to transition. They'll start buying stuff from Mexico, whatever. So there's that aspect of it. The other aspect, of course, is the commodities that Canada has. Well, you know what? We actually don't have a whole lot beyond the oil sands. And of course, it's a major thing. Most of the gold miners that are listed in the world are Canadian, listed in Canada, but we actually don't mine a whole lot of gold in Canada, right? It's all over the world. They just happen to be listed there. So capital accounts versus trade accounts, different money flows. There are some calls by the economists of the banks that we might see 110 again, and I wouldn't rule that out. Right now, I've been buying U.S. dollars because I'm worried about a market pullback, and Canadian dollars correlated to that. But so from a trading context, I'm not real bullish on the Canadian dollar here. But if you talk about the next 4 or 5 years, the relative difference in the fiscal situation in Canada to the U.S., likely outcome that oil is going to $200 in 5 years, Canadian dollar is going to go up, but it's going to, our growth as a nation is going to be weaker. But higher bumps along the road because of the, when oil prices fell, Canadian market got devastated because of the weights in commodities and energy. And then the Canadian dollar went from parity, or 110 at the peak in 2007, down to about 77 cents to the US dollar. You know, the real purchasing power parity is probably in the 90-cent range. So we're overvalued fundamentally, but we're overvalued for capital flows and investment flows. Is that enough of a hedge for you?
This question is from Larry. Larry, I mean, it is to some extent reasonable to assume that stocks really don't do what economists do. I mean, much of the macro thing and much of the economists, if you ask them, listen to you. How do you then, go around, picking stocks and doing what you do as a portfolio manager? Because if you want to keep on thinking as an economist, you're always going to be out of the market.
Well, it could be. That was Sid. He was my junior guy at CIBC, and now he's the senior guy. So it's a planted question. No, it's not. Well, as you know, Sid, I don't do stocks. I do ETFs. But we're starting to do some stock. I look at a stock as an asset. I have no love for the company or hate for the company. If I can make money relative to something else, then I'll buy that stock. So, if the regression line is positive, so it's outperforming on a trend basis and it gets technically cheap or oversold or whatever phrase you want to use, then on a risk-reward basis, it merits adding to the portfolio. So if you're trying to beat the S&P 500, you can maybe pick 100 stocks and do something like that. And when something gets relatively cheap, you sell out something expensive and you buy something cheap and use money management rules. Because of that, we don't know what's going to happen tomorrow. It might get a lot cheaper. So you say, okay, well, I'm willing to risk 10% on this 1% position in my portfolio, and it doesn't work, and you stop out, you find something else. So if you work on probabilities and not fall in love with the companies and their stories and their management, then you get a clearer head. And so that's what I try to do.
Well, one thing I could add on that, I grew up kind of at Morgan Stanley. It had a big economic team, and still does. It was great as a technician because no matter how much you screwed up the technical forecast, there was always an economist around.
Cue the drums. Are there any other questions? I had one more, unless there's any from out there. I'll let you guys go first. But just, I noticed all three of you, rely on relative strength studies. And just what I'm finding is we're talking to clients, I'm sell side, but more and more portfolio managers are very interested in using relative strength analysis. And I was just wondering, do you think it's worthwhile to apply like classical technical studies to the relative strength charts? Like I noticed, if a relative strength trend line is broken, you'll note it. But could you use oscillators on that, say like an RSI? Do relative strength, does that get overbought, oversold? Larry, you look like you want to.
So the orange line is the relative performance of one versus the other. So I run regressions on it. The bottom line is the RSI based on the relative line. So absolute and relative performance is very important. The only way a manager stands a chance of beating the market using tools is understanding the relative weightings. It's the only way. There's no other. I mean, you can look at chart patterns, but they work 50% of the time, most of them. Right? So it's money management rules that make us successful in beating the market. It's not technical analysis.
I would just add, and again, this is another one of Frank's concepts, and I hope I'm not stealing his presentation. But if anything that trends and follows the schematics that we look for, whether they be lasting trends and reversals and crossing of the moving averages, anything that trends you can apply these concepts to. So whether you're talking about the price of the market, price of wheat, the price of collectible baseball cards, whatever it is, if the price is determined by supply and demand, then these concepts can be applied, and then the relative line also over periods of time trends, and so therefore any of these tools can be applied to that as well, and we do that.
Under that line, are there any sectors you're seeing like right now that look extremely out of favor relative to the U.S. markets, or perhaps I know Larry, you pointed out emerging markets relative to the U.S. look undervalued, and again it was on your relative strength chart. Anything in the U.S. that would come across as being technically significant that we should be looking at?
My stuff, obviously, all the defensive stuff, staples, utilities, I mean, they all stand out right now is because the cyclicals have been very strong and rallying, and the energy's growing part of the index. And so, to me, that's the only thing that stands out right now in the U.S.
Mark or Dave?
Yeah, I think that the last 2 years is noted by the remarkable absence of any kind of sector rotation. Most of the themes that were true early on off the low have been in place, with the exception of maybe energy coming on strong in the last few months. Just getting back to the prior question, I think that most of us are analyzing charts, but on the buy side, you get actually measured on portfolio construction. So I think technicians often get into trouble because they make bets as a result of having a portfolio, even though they're analyzing individual charts. So we spend a lot of time measuring that, kind of how far we are off on the, in one extreme in terms of having a momentum bias or, owning winners is typically the big bet that often gets you into trouble when the market does turn.
And then just, I would say, if you're focusing on sectors, it can be a bit misleading because just within the healthcare space, for example, I mean, you can actually dig through that sector and find probably enough stocks to build an entire portfolio that have proper trend structure and that are outperforming the market. So it is important to know what the sector is doing from a tailwind perspective. I mean, if you can find enough stocks within a sector to build an entire portfolio and the sector looks great, you've got a winner. But that's just because a sector doesn't look good. Certainly from a portfolio construction standpoint, it often pays to actually dig beneath the surface and try to find ideas in there as well, because if you have an entire sector that's going down and you're able to pick stocks within that bucket and get equal weight to sector and have stocks that are actually doing well, I mean, that's a huge alpha source right there.
All right, well, with that, we will wrap it up, but I want to thank Mark, Dave, and Larry for their time, and thank you all.